Deva corrected his bank letter, hands shaking. $6,300. She is 32 years old and doesn't understand how she ended up here. It began with a small pink button. On her favorite shopping app, it gleamed, "Buy now, pay later." She thought it was smart. Pay $30 now, $30 next month. It felt like it cost nothing. Klarna, the Swedish app, promoted a payment experience that was simple, smooth, and almost fun. But over time, the purchases piled up. Dresses she no longer wears, forgotten delivered meals, and useless gadgets. One morning, the withdrawals began flooding in. A small amount here, another there, until her account looked like a leaky boat. Little by little, Klarna sucked everything up like a black hole. At first, Deva thought he could manage, but now every bank alert makes him feel nauseous. So she does what any millennial on the edge would do. She shares her story on TikTok.
I have $6,300 in minimum payments.
In 24 hours, the video blows up. 2 million views, and her inbox is flooded with stories. "Me too, Klarna ruined me. I have $15,000 in debt. Klarna, I can't sleep anymore. This app ruined my family." Deva realizes she's not alone. She's one of millions of young people trapped by the same little pink button. As his victims struggle with debt, Klarna Chief Executive Officer Sebastian Semyakovsky surveys his empire. And a question begins to haunt him. Did I create a monster? He'll get his answer in May 2025, and it will traumatize him. So how did this app, which was meant to reinvent online payments, end up deliberately targeting the most vulnerable people? What is the mechanism that made its customers addicted to debt? And above all, how did a fintech valued at $45 billion dig its own financial grave? Hi, Entrepreneur Mindset. I hope you're doing well. Recently, while mentoring a young entrepreneur, I realized just how much installment payments have become the norm among people under 35. And above all, what struck me is how many people think they're getting a good deal because it's an interest-free loan. We looked into this with the team. I should introduce them since we're nearing 500,000 subscribers. Thank you so much for that. Today, I'm taking you behind the scenes of a business that turns people, young and old, into financial zombies. It's a pretty terrifying story, made up of consumerist dreams, toxic debts, and illusions of wealth that vanish at the speed of a click. This time, instead of my usual business mindset lessons at the end, I'll share 6 tips to help you avoid the trap. By the way, don't hesitate to share it with someone who might benefit from it. Let's get started. Dirty snow clings to the sidewalk at -8 degrees. In the busy halls of the Stockholm School of Economics, the entrepreneurship competition is underway. 3 students step forward. Sebastian Semyakovsky, 23 former Burger King cashier, Nicholas Alderberf, 23 insomniac geek, and Victor Jacobson, 23 passionate about balance sheets. Sorry if I mispronounced their names. Their project is still called Creditor. The concept is simple. Give merchants money up front and let customers repay in installments with no visible fees. They want to make e-commerce smoother, allowing anyone to shop online just like buying a subway ticket. Pay later stress-free without needing your bank card immediately. The jury smiles politely and replies, "Excessive risk. Within 3 weeks, more than 20 investors will say no. More than 20 investors will say no." One evening in the quiet school hallway, the 3 students drag their bags after another rejection. The neon lights flicker and a woman approaches them. Jane Walrud, a notable figure in Sweden's ecosystem, sold her startup for several million. She enjoys finding ideas others won't fund and asks creators to pitch to her. Sebastian sums it up in 30 seconds. Shopping online without stress. The merchant gets paid right away. The customer pays back later with no fees. Jane sets the terms, then she says, "I'll give you 60,000 euros and I'll lend you. I pay 5 Ukrainian developers, but I want 10% of your company." Silence. The guys are shocked. This is the first concrete offer they've received. You doubt it? And unlike the founder of Snapchat, whose story I told you about recently, he signs right away without hesitation. A few days later, he rents a 2-room apartment in Södermalm, a creative and startup hub. Days are spent with filter coffee, nights with coding and cold pizza boxes. In this small apartment, Klarna will come to life. A project quickly assembled by three people that became real. Their dream had just taken its first breath. In April that year, their first client, a small online bookstore called Pocket Lubin, agreed to try it. He initiates a test transaction, a crime novel for 129 Swedish kroner, under 12 euros. Sebastian clicks. Silence. Then the notification arrives, payment is processed, the bookstore is credited instantly, and the buyer has 30 days to pay. He looks at himself, relieved and excited. It works, the concept is validated. For the merchant, it's tempting. He sells more and increases his customer's average basket. Who thinks, why spend 20 when I can spend 50, since I'm paying in 4 installments? But with every click on the pink button, a part of his revenue evaporates. He makes money fast, but it'll cost him later. We'll return to that later. For 5 years, Creditor steadily chips away at Swedish e-commerce. Small online shops love it. They get paid instantly, risk-free. Customers quickly adapt to this new freedom. Buy now, pay later. But the name Creditor sounds a bit too cold, too much like a bank. In 2010, he changed everything. New identity, new ambition, Klarna is born. A pink button starts to appear on merchant websites. Discreet yet irresistible, Klarna processes 40% of Sweden's online purchases annually. In June 2021, SoftBank's investment fund arrives with a colossal check, $639 million. Klarna's valuation skyrockets to $45.6 billion. Sebastian at the top proudly tweets from his phone. The payment revolution is just beginning. To celebrate, Klarna hires a $AP Rocky, an American rapper and model, for the global Get Smooth campaign at a high price. In the video, he slides in slow motion on a pink carpet, Klarna card in hand. The message is clear: no friction, no pain, no bumps. On TikTok, the hashtag Klarna Haul is trending. Teens and young adults show off sneakers, iPhones, and makeup palettes. Everything is paid for. Later, Klarna becomes the cool bank, the adrenaline-fueled PayPal. Its goal is simple: make every customer feel richer with a single click. But behind the pink neon, an invisible meter is already ticking. Each click is a deferred debt, each dress a reminder of a postponed payment. And soon, Clara will discover that she has created an army of financial addicts. Clara Morell is 26 years old. While sitting on her couch scrolling through Zalando, an alert appears. Your leather jacket is 30% off. She adds the jacket, 249 euros. She instantly adds sneakers for Wacho worn 129. On a whim, she adds Gucci glasses costing 389 euros to her cart. Well, this couldn't have happened to a subscriber with an entrepreneur mindset, because you know how much Gucci rips you off. But let's get back to Clara. When it's time to pay, a red button appears. Pay in 3 installments with Klarna. 1 click, no card code, and a 3rd charge right away. The package arrives Thursday. The 2nd payment is due in a month. Clara is already on her 6th split order since January. A LED television, 2 concert tickets, 6 deliveries. The bill now totals 3,850. She reassures herself, I'll pay it back. In France, half of customers using this method pay at least 1 installment late, according to Views. This market is now worth 12.7 billion euros in France and is growing 11% annually, according to Yahoo Finance. And the profile of addicts is known: Gen Z or young millennial. Low annual income, unstable jobs, internships, short-term contracts, or first salaries that barely cover expenses. Their budget is already squeezed by inflation. Every tank of gas, every grocery basket feels like a blow. So, when the little pink button, paid in 3 or 4 installments, appears, it's like an emergency exit. Treat yourself without immediately checking your account. A smartphone, sneakers, or luxury lipstick. The purchase is instant, but the price is split into small, almost unnoticeable monthly payments. And very quickly, these small amounts pile up until the day the total sum explodes. It's always the same story. Opening a Klarna account only requires an address, mobile number, and card. Creditworthiness is determined by a quick algorithm. However, if Clara misses a single payment, Klarna, everything changes. First, a notification dues arrives 2 days before the deadline. Thus, on a D-Day, if the withdrawal fails, Clara automatically tries again a few days later. Fixed fees are €3 for totals under €100, €5 for 100 to €200, and €8 for over €200. Each missed payment adds fees to the next bill. If Clara misses multiple reminders, her debt may go to collections and her Clara account will be blocked. The real risk is when each installment exceeds €100. An incident can be reported to the Banque de France's Fichier des incidents de remboursement des crédits aux particuliers crédit incident file. For 5 years, Klarna never rewards on-time payments, but even the slightest delay can mark your record for life. But the startup also incurs costs. In the first quarter of 2025, Klarna reported $136 million in losses related to unpaid debts, up 17% year over year. The more the company attracts vulnerable customers, the more defaults skyrocket and the more its cash flow bleeds. Every package bought on credit is a ticking time bomb quietly counting down. And you'll quickly realize that this vicious cycle is fueled by those you'd least expect. The halls of Bercy are still lit despite the late hour. In a meeting room, red folders marked split payments, 100 cups on the table, an advisor turns to the chief of staff. How could we let these mini loans slip under the radar and create the illusion of easy credit? Because yes, this illusion grew faster than any other financial service. In France, installment payments soared to $12.7 billion in 2025, up over 11% from last year. However, an internal study shows half of users pay at least one installment late. Each default results in reminders, penalties, and may be reported to the Fichier des incidents de remboursement des crédits aux particuliers for 5 years. One click can turn buying sneakers into a lasting mark on your bank record. For platforms like Klarna, these small debts have become a hidden burden. The Fintech will bundle receivables and sell them as bonds on Wall Street to get cash back. But the more defaults increase, the more investors demand double-digit returns. When money outweighs promises and promises falter, everything becomes unstable. But in all this, you might be asking, what about the merchants? I mentioned them to you earlier. Initially, everyone viewed Klarna as a guardian angel, making it easy to boost sales. It's true, they quickly collect money and boost average basket size, but at a high cost. Klarna charges between 3 and 7% per transaction, much higher than standard card fees. The worst part is handling returns or disputes. Some platforms will also pass the losses on to the merchants, who end up absorbing the collection fees. The result is that the promise to boost conversion often hides a much harsher reality. Margins shrink and dependence on these solutions sets in. Experts at Bercy in France are preparing a response. Our ministers do earn their pay. They're closely monitoring the European Consumer Credit Directive 2 directive, set to take effect in 2026. A French proposal is circulating to classify any installment payment over €100 as consumer credit. That would require every merchant to check their customers' creditworthiness and report any payment incidents. For the first time, good behavior will become visible. And if the measure comes into effect, Klarna will lose its smokescreen. And when the light shines on the mountain of hidden debt, the countdown will begin. On the 8th floor of Klarna's headquarters, the blinds filter a gray light. On the video conference screen, the chief financial officer displays the quarterly results. No one speaks. The executives keep a mask of politeness. The valuation has dropped from $45 billion to $6 billion in less than 2 years. Loan losses topped $136 million in 3 months, up 17% from last year. Investors are demanding an immediate slimming down. 150 layoffs instantly. The words cut through the glass-walled room. A manager responds, cutting teams won't help if clients stop paying. The cash drain doesn't come from salaries. It comes from every little package paid later, which has become a debt that grows week after week. Every euro spent on marketing attracts a new user and sometimes a new payment default. Management is starting an emergency $800 million fundraising round to buy time. The investors agree but impose a steep discount. The unicorn gives in. Better a lifeline than a pretty picture of a dead unicorn? Meanwhile, SoftBank reports billions in losses. We should talk about SoftBank and its founder sometime. An eccentric billionaire who invested incredible amounts. Many startups failed, leading to headlines. Scandinavian Fintech is no longer a dream. Engineers share LinkedIn jobs on Slack. Human resources emails are repetitive. Don't panic, but the financial debacle is already an open secret. The initial public offering, which is supposed to be the crowning achievement, has been postponed indefinitely. Investment banks just shrug. No profit, no windows. The cycle is clear. As Klarna offers more easy credit, defaults rise. Higher defaults make fundraising costlier and further dilute the founders. The faster the dilution accelerates, the more employees lose confidence and the market slips away. Sebastian sets the glass ceiling. He reviews the pink campaign with Isaproki. The slogan, "Get smooth." Today, the surface is anything but smooth. Each debt is a shard of glass ready to cut. Outside, the storm is starting, and Klarna isn't alone. From Paris to San Francisco, all buy now, pay later fintechs face the same cycle: fast growth, vulnerable customers, and rising unpaid debts. If the wind picks up a little more, it won't be just one unicorn that falls, but the whole herd. So, friends, as promised, here's how to avoid multiple payments. Only use installments if you can pay the full amount up front. These offers are just hidden credit. If your account lacks the funds, you're already taking a risk. Next, limit the number of open installments. Accumulating several payments in 3 or 4 installments can quickly get out of control. Keep a spreadsheet or set up alerts to know exactly what will be deducted next month. Monitor your withdrawals. Most incidents happen because an account is underfunded or due to forgetfulness. Set up an alert 2 days before each due date, then check the conditions before clicking. Some delays result in fixed fees, 3, 5, or 8 euros, and may be sent to a collection agency. Knowing this in advance helps you avoid unpleasant surprises. Also, don't finance impulse buys. Paying in installments is meant to spread out a one-time expense, not to buy more than you can afford. Remember, your history matters. A single major late payment can stay on your fichier des incidents de remboursement de crédit ou particulier record for 5 years, even if on-time payments aren't always visible. Understanding credit, cash flow, and risks isn't just a matter of survival, it's also the story of massive fortunes. That's what Visa's founders, creators of capitalism's most powerful monopoly, understood, which was born from a monumental mistake. A mistake that turned a small card into a global empire, as you can see in the video that's showing.